Everyone, welcome to Fox and Media Digital. My name's Amy, and today I'm joined by Ian Williams, who's Chairman and CEO of Charteris Treasury Portfolio Managers. So, welcome, Ian. It's great to have you on the channel.
Okay, thank you for having me.
Yes, Ian, you spoke at the Summit for Wealth Management recently in London, so it's great to catch up with you on our channel. And we just want to get to know you really and find out a bit about yourself and about your firm. So, could you tell us a bit about your background?
Okay, well, as you said, I'm Chairman and CEO of Charteris Portfolio Managers. Um, I personally run a specialist gold and precious metals fund, also run a government bond fund, and I also run a UK income equity fund as well. So I run three different funds, as well as looking after private clients.
Yeah, so could you tell us a bit about how those different asset classes are performing this year? So how is the bond market doing? And especially when it comes to gold and precious metals, curious to hear about that because that's not something we talk about that much on this channel.
Okay, we cover gold first. One. Um, what's been happening in the gold market at the moment is very unusual in that if you subdivide the precious metal sector down into component parts, i.e. gold bullion, silver bullion, and gold and silver mining shares, some very strange things are happening. So gold, for example, is hitting all-time highs. It's virtually an all-time high, whereas silver is nowhere near its all-time high, and the mining shares are equally not doing very well, despite the fact that most of the majority of what they do is gold mining, and gold is hovering around an all-time high, and that the cost, one of the major costs of a gold miner is oil, energy costs, and they've been going down. So logic would dictate that gold shares should be doing very well at the moment, and they're not. They're struggling. And what we think is happening is that there's separate buying and selling camps for these individual subcomponents of the sector. Namely, gold is being bought, gold bullion is being bought by Asian central banks in vast amounts. But Asian central banks don't buy silver, and they don't buy mining companies. So that market for silver and for the mining stocks is dominated by US investors. And if you track the price of gold mining shares, they're correlated with silver, not with gold, despite the fact that hardly any of them mine silver, they all mine gold. So it's a little bit bizarre, but I think it's explained by the fact that you've got two distinct camps that are playing in the market. And the Asian central banks are buying gold for geo-political reasons. There's lots of talk that Russia and China and India, the BRICS countries, are working on an alternative currency to the dollar. And there's also a lot of talk that it's going to be gold-backed. So if that is the case, you need an awful lot of gold to back a new currency to give it credibility, which is why I think they're buying the gold. And they're not bothered at all about what the Federal Reserve is doing with interest rates. They're buying it for a completely different reason. Whereas the American investors are obsessed with what the Federal Reserve is doing. And every time the Fed is putting rates up, silver and gold mining chips is causing that sector to struggle a bit.
No,
But
that
what
makes
it means
sense.
is that, what it means is that the gold shares are now trading at enormous discounts to what you would perceive their net asset value to be, where the gold price is already, never mind gold going higher. So there's an arbitrage there that at some stage will get unwound. But I suspect it won't get unwound until the Federal Reserve starts cutting rates, and then it'll get unwound potentially with a bang. So gold shares are looking very cheap at the moment relative to where gold is, but they're probably going to stay cheap until the American investors become less risk averse.
No, that makes sense. Thank you for that overview of everything. It definitely, I can see why that's the case. And thinking about how this feeds into the wealth management industry, how are these different price disparities between gold and silver affecting the way private clients are investing? Because of course, it's the Asian central bank that you say that are, investing in gold. So is it affecting private clients, ultra high net worth individuals, and where they're putting their money?
I mean, what we're seeing is that people can see that these gold mining shares are trading at big discounts to where they, in theory, ought to be traded. And they equally appreciate that they're not going to see, it might be trading at a 40% discount to where they should be, but they're not going to make 40% next week because it's not going to get unwound next week. But it should get unwound over maybe a year or two. So I think people who are prepared to take a longer term bet and to quietly buy the shares, the better ones in the sector. Uh, so but a lot of what they call the generalist investors are just ignoring the sector completely. They just prefer, well, if it's not going, if nothing's going to happen for a few months, then I'll wait for a couple of months before I get interested. So there's no disinterest in the sector as well, which doesn't apply to the gold bullion market because it's being bought for different reasons.
No, that makes sense. And you touched
And
as well on you have an equity and a bond fund as well. So what kind of activity you see in those markets?
okay, well, with the bond fund, we've been very short dated gilts for a year, which has worked out really well. But in the last couple of days, we started switching the shorter dated gilts into the longer dated funds because we think the gilt market's gone down enough now, and we think the yields are backed up too much. A couple of days ago, 10-year gilts were yielding more than 10-year Greek bonds, which is crazy. So we think gilts are now gone from being too expensive to probably a bit too cheap. And so we've been switching out the short dates into the long dates. And generally speaking, one of the reasons, going back to the gold, why US, probably UK investors as well, have got so risk averse, especially the US ones, is that the US yield curve, the US Treasury market is the most inverted it's been for since the 1980s. And last year, American investors lost an absolute fortune in tech stocks. They lost an absolute fortune in bonds. And now they can get, because of the inverted yield curve, they can get 5% or 4.5% in a 1 year US money market fund. And so uh, there's billions poured into these money market funds from investors who are risk averse, but also depositors taking money out of regional banks because they weren't sure that some of these banks are maybe going to survive. So you've got an enormous amount of money going into the sort of 1, 2 year US Treasury bonds. It's happened more in the States than it's happened over here, but it's also happened over here as well. People are very risk averse at the moment. And the inverted yield curve is screaming that you're going to get a potentially quite nasty recession in America and possibly over here as well. And you can back that up with the US money supply is now negative, showing negative growth. That's the first time this has happened since 1933, 90 years ago in the Great Depression. So some really serious forward-looking indicators telling you that there's potentially a nasty recession on the way, which again backs up our view that it's probably time to start venturing into the long end of the government bond markets, both in the UK and the US.
Yeah, of course. There's so much unprecedented things happening in the past year or two that we've seen. So I think you've mentioned ways that we can look ahead and what's to come. So how could we have better forecast the state of the market? You mentioned some of those geopolitical factors, but when it comes to inflation and some of the unprecedented sort of black swan events, what could investment managers and wealth managers have done to sort of get ahead with this sort of thing?
Depends what sort of style they follow. I mean, we follow a value style. So we tend not to chase momentum. But a lot of investors are momentum players. They just try and catch up on one of the bandwagons going up. So this year, for example, the tech shares have done very well. Best people are now betting on artificial intelligence. But if you take Facebook, if you put £100 in a Facebook set 2 years ago, it went down to £25 last year. It's gone up to £50. And everyone's jumping up and goes, hey, it's correct. Facebook's doubled it. But it's only doubled from a very low base where it got absolutely destroyed the week before. And the market breadth is getting narrower and narrower, which is not a healthy sign. So the whole S&P and Nasdaq are being dragged up by about 6 or 7 stocks, and all the other stocks aren't doing very well. And it's getting a narrower and narrower market breadth, which is a bearish sign, it's not a bullish sign. And eventually, one or two of those drop out. So Nvidia, for example, that's just gone to $1 trillion market cap. Is it really worth $1 trillion? I mean, it's on an enormously high rate now. As value investors, we probably wouldn't buy that now. We'd think, no, it's been chased up. Um, I think it struggles to justify $1 trillion market cap. And that may be the next one that stops going up. And then eventually you can probably just say with Microsoft, one or two others betting on this AI. So none of this is a particularly healthy sign. Couple that with a recession potentially coming up that the bond market's telling you about, and the equity market could be in for a bit of a struggle. But in the UK, shares are so cheap. And like gold shares are already selling at a recent discount to where they should be, given where gold is trading. There was a CEO, I think, on one of the TV business channels of Land Securities, I think, and he was complaining that his shares were selling at a 40% discount to what his property portfolio was worth. So UK equities are just cheap. I mean, so if you've got American equities are probably the other way, they're probably overvalued. So if you've got a big sell-off in the US equity market because value starts to assert itself, it wouldn't necessarily affect the UK shares anything like as much because they're already quite cheap to begin with. They're already, a lot of them already undervalued. So if you're a value investor, we're looking at this stuff and saying, look, it's good value. They're worth holding. But don't expect any instant results because if the US market starts going down, the UK market might not go down as much, but it's probably not going to be going up if the US market goes down. So again, if you take a slightly longer term view, there's a lot of decent things to buy. And also, the other advantage with the UK equities is that it's huge and yields, which you tend not to get in other markets. So you can buy a selection of blue chip UK equities and get 5, 6, 7% dividend yields. Okay, so inflation might be sort of 6 or 7% or wherever it is at the moment, but that's probably not going to stay at 6 or 7%. That's going to come down. And if it continues, that means you're most of these equities tend to, with a bit of a lag, put their dividends up in line with inflation. So again, this means that the future growth of the dividends is going to be potentially higher as well. So all things considered, all the time these central banks are pushing up rates, it's a bit like pushing Trump hill. But if we reach the period where the latest buzz is that the Fed's going to pause and not put rates up anymore for a while, then the market should settle down. And if then inflation continues to come down, the forward indicators of inflation, like oil and money supply, are all pointing to lower inflation, not higher inflation. We may have seen the peak in interest rates, which is what the bond market, the treasury market is telling you. But that's all got, all those bonds have got 3% handle. So they're saying that the Fed isn't going to go to 6 or 7%. Bond market's telling you that its rate rises are virtually over. So if the rate rises are virtually over, give it a few months and in time, put all this stuff to put through, then yeah, at some stage, when we go into reverse this and the recession turns out to be too deep, they'll start cutting rates and they might start cutting them quite sharply. Then you'll see all the markets start to perform. That's when you're going to make the money. That's when the suddenly equity markets start going up, the bond markets start going up. And the biggest one of all is that gold probably is going to blast all the way through 2100 or something, because once they start cutting rates, the high interest rates in America is the only thing supporting the dollar. It's not much else. And so if the dollar starts coming down, all the American investors start piling into gold. And that's probably when you see silver start to perform, because once the American investors start buying gold, they'll start buying lots more silver because they use silver as gold on steroids.
No, it makes sense. And in light of all this, then, as closing thoughts, what are your sort of goals for the next 12 months? You just continuing on this course with, as you mentioned, the things that you're already invested in, or are you going to sort of, watch out for any upcoming developments like that?
Yeah, I mean, at the moment we're not chasing momentum, so we continue to hold all the value stocks in the market, all blue chips, all with low borrowing. We don't want anything into a recession that's got too much gearing on its balance sheet. And quite happy to hold them, sit this all out, because once the central banks stop putting rates up and start cutting them, which we think they will, then all these sectors are going to start to make some decent money. But that's probably not going to be next week. It's, equally, it's within the next 2 years. It's not 10 years away. So we think the market started to perform somewhere around the beginning of 2025, start to see some real money made. You might have a sort of bit of a bit like take a boat out and a bit of turbulent water for the next year, 18 months. After that, then plain sailing for 2 or 3 years.
No, it makes sense. And fingers crossed, like you say, that it does ease and get better and, sooner rather than later. So thank you so much, Ian, for shedding some insight today and telling us a bit about, what your firm's focused on. It's been really helpful having you. So we look forward to having you at future events on our channel again.
Thank you.
And thanks everyone for watching.